Wall Street. The name itself conjures images of wealth, power, and ambition. It's a place where fortunes are made and lost in the blink of an eye. The air crackles with energy, fueled by the constant flow of money and the relentless pursuit of profit. Young men and women flock to Wall Street, lured by the promise of a life less ordinary. They dream of seven-figure salaries, luxurious apartments, and the intoxicating thrill of the deal. The reality, of course, is far more complex. For every Wall Street success story, there are countless tales of shattered dreams and financial ruin. The market, like a fickle mistress, can be both rewarding and ruthless. It demands unwavering focus, a tolerance for risk, and a certain ruthlessness. Only the strong survive on Wall Street. The weak are devoured, but the allure remains. The chance to strike it rich, to beat the system, to rise above the ordinary. It's a siren song that continues to draw the ambitious and the hungry. And in the roaring bull market of the mid-1980s, that song was louder than ever. To understand the events of Black Monday, one must first grasp the basic mechanics of the stock market. At its core, the market is a giant auction house, where shares of publicly traded companies are bought and sold. These shares represent ownership stakes in the company. When you buy a share of stock, you're essentially buying a tiny piece of that company. The price of a stock is determined by supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price goes down. Brokers act as intermediaries in this process, connecting buyers and sellers and executing trades on their behalf. They earn commissions on each transaction, so the more they trade, the more money they make. Investors, on the other hand, make money by buying low and selling high. They hope to buy shares of a company when the price is low and then sell them later when the price has gone up, pocketing the difference as profit. Predicting the future movements of the market is a notoriously difficult task, even for seasoned professionals. The New York Stock Exchange, located on Wall Street in Lower Manhattan, is the most famous stock exchange in the world. In the interconnected world of finance, what happens in one market can have a ripple effect on markets thousands of miles away. While the stock market can be a powerful engine for economic growth, it's also susceptible to manipulation and abuse. Greed, after all, is a powerful motivator, and in the high-stakes world of Wall Street, some are willing to bend or even break the rules in pursuit of profit. One such unethical practice is known as pump and dump. This scheme involves artificially inflating the price of a stock through false or misleading information. The perpetrators, often insiders with knowledge of the company, then sell their shares at the inflated price, leaving unsuspecting investors holding the bag when the price inevitably crashes back down to earth. Another shady tactic is front-running, where brokers use their advanced knowledge of a large order to buy or sell a particular stock to their own advantage. But perhaps the most insidious threat to market integrity is the rise of program trading. These concerns would prove tragically prescient on Black Monday. The seeds of Black Monday were sown long before that fateful October day. Throughout the summer of 1987, warning signs had begun to flicker. Interest rates were rising, making it more expensive for companies to borrow money and potentially slowing economic growth. Some market analysts whispered that stocks were overvalued, that the bull market had gone on for too long, and a correction was overdue. But their warnings were largely ignored. On Friday, October 16th, a wave of selling hit the Hong Kong stock market, sending share prices tumbling. The sell-off quickly spread to Europe, where markets were already on edge due to concerns about the US economy. By the time the opening bell rang on Wall Street on Monday, October 19th, a sense of unease had settled over the financial world. The Dow Jones Industrial Average opened lower and the selling quickly intensified. Traders, many of whom had never experienced a bear market, watched in disbelief as the Dow plummeted hundreds of points. The ticker tape, which displayed stock prices and trading volume, couldn't keep up with the onslaught of sell orders. Fear, like a virus, spread through the financial system. As the market plunged, a dangerous feedback loop kicked in. Program trading, designed to capitalize on market trends, began to accelerate the sell-off. These computer programs, sensing a sharp decline in prices, automatically executed sell orders, further depressing the market. Adding fuel to the fire were margin calls. When investors buy stocks on margin, they're essentially borrowing money from their brokers to finance the purchase. If the value of the stock falls below a certain level, the broker can issue a margin call, demanding that the investor deposit more funds to cover the loss. On Black Monday, margin calls cascaded through the system, forcing desperate investors to sell their holdings at any price. This further overwhelmed the market, leading to even steeper declines and triggering even more margin calls. The floor of the New York Stock Exchange, normally a scene of controlled chaos, had descended into utter pandemonium. By the time the closing bell finally rang, the Dow Jones Industrial Average had plummeted a staggering 508 points, a drop of more than 22%. It was the largest one-day percentage decline in the history of the Dow, eclipsing even the crash of 1929. The total value of the U.S. stock market had shrunk by over $500 billion in a single day. Black Monday, as it would forever be known, had arrived. The images from that day are seared into the collective memory of Wall Street traders with ashen faces staring at flashing computer screens, phones ringing off the hook, crumpled sell orders littering the floor like confetti after a ticker tape parade. The air, thick with tension and the stench of fear, was punctuated by the occasional sob or anguished cry. The impact of Black Monday was felt far beyond the walls of Wall Street. Retirement savings were decimated. The American dream, for many, had turned into a nightmare. The days and weeks that followed Black Monday were a time of reckoning. The financial world, shaken to its core, struggled to make sense of what had happened and to prevent a repeat of the disaster. The Federal Reserve, America's central bank, injected billions of dollars into the banking system in an effort to prevent a complete meltdown. Congress launched investigations, determined to uncover the causes of the crash and to hold those responsible accountable. But for some, the damage was already done. Companies that had been flying high just days earlier were now teetering on the edge of bankruptcy. The casualties of Black Monday included investment banks, brokerage firms, and even a major airline. The human cost of the crash, measured in lost jobs, shattered dreams, and financial ruin, was incalculable. Among the most notable bankruptcies was Drexel Burnham Lambert, a once mighty investment bank that had been a pioneer in the use of junk bonds. But as the saying goes, one man's trash is another man's treasure. While many were left reeling from the carnage of Black Monday, some saw opportunity amidst the wreckage. These savvy investors, sensing that the market had overcorrected, began buying up stocks at bargain basement prices. Their bet, which proved to be a shrewd one, was that the market would eventually recover. One such investor was Paul Ruback, a young finance professor at MIT who had been studying the stock market crash of 1929. Ruback, convinced that the market had overreacted, persuaded his university to invest a significant portion of its endowment in undervalued stocks. The gamble paid off handsomely, and MIT's endowment soared in the years that followed. Short sellers, who profit when the price of a stock goes down, had a field day on Black Monday. As the market plunged, their profits soared, adding to the sense of unease and anger among those who had lost their savings. In the aftermath of Black Monday, conspiracy theories swirled. Some whispered that the crash had been engineered by a shadowy cabal of investors, intent on profiting from the chaos. Others pointed to the role of program trading, arguing that these computer programs had exacerbated the sell-off and made the crash far worse than it otherwise would have been. The Securities and Exchange Commission, the agency responsible for regulating the stock market, launched a massive investigation into the causes of Black Monday. While the SEC's report, released several months later, attributed the crash to a confluence of factors, including program trading and a lack of market liquidity, it did not rule out the possibility of insider trading. Whispers persisted, however, that some investors had possessed advanced knowledge of the crash and had used that information to their advantage. Rumors circulated about well-connected individuals who had sold their stock holdings in the days leading up to Black Monday, only to buy them back at a fraction of the price after the market had bottomed out. But despite numerous investigations and congressional hearings, no concrete evidence of insider trading was ever uncovered. The events of Black Monday remain a cautionary tale, a reminder that even in the most sophisticated and regulated markets, the potential for sudden and catastrophic losses is always present.